So now let's have a quick recall of IAS 36 impairment of assets. If I could have a quick recall of IAS 36 impairment of assets. So what do we know about impairment? As per IAS 36, whenever the carrying amount, what do you mean by the carrying amount? The net book value of an asset. Whenever the carrying amount of an asset exceeds its recoverable amount, so we say that there is actually an impairment. So what is an impairment loss? Whenever the carrying amount of an asset is greater than or is exceeding its recoverable amount, we say that the impairment loss has taken place. Now for example, if the carrying amount of the asset is 100 million and the recoverable amount of the asset is, let's say, 90 million. So we say there is an impairment loss of 10 million. But at the same time, if the carrying amount of the asset is 100 million and the recoverable amount is 110 million, so we say there is no impairment. Why? Because the impairment loss only arises when the carrying amount of the asset exceeds the recoverable amount. Now, the second thing that we have to recall is that what exactly is the recoverable amount? So the recoverable amount is the higher of fair value less cost to sell and the value in use. What do you mean by this fair value less cost to sell? So fair value is established as per IFRS 13. Whatever the market value of the asset, whatever the fair value established as per IFRS 13 would be considered as fair value. Less cost to sell, we also call it selling cost. So assume that there is an asset whose market value is 110 million, and if you are going to undertake this sale, then what would happen is there is going to be a 12 million cost that would be incurred to sell this. So resultingly, what is going to happen is we would say that the fair value less cost to sell is going to be 98 million. Now the second thing is, there is another concept which is called value in use. What exactly do you mean by value in use? So value in use is simply what? It's the present value of future cash flow. It's the present value of future cash flows from what? From the continuing use of asset. And from its ultimate disposal. That is, if you have acquired an asset and if you continue to use it, and then you ultimately dispose it off, so whatever the net cash flows that arise, we would calculate the present value of those net cash flows. And the present value of those net cash flows would be termed as value in use, or other way around you could say the benefit from the use of the asset. So assume that the value in use of the asset is, let's say, 103 million. So if I have the fair value less cost to sell of 98 million, the value in use of 103 million, so resultingly my recoverable amount is going to be 103 million because it's the higher of what? The fair value less cost to sell and value in use. So that's one of the concepts that we have recalled with respect to IAS 36 impairment. Now, assume that the impairment loss has arisen, what happens then? So if the impairment loss has arisen, so you have to recognize it. How exactly are you going to recognize it? It would depend upon whether the asset is being carried under the cost model or the revaluation model. Assume that the asset is carried under the cost model, then the whole of the impairment loss would be recognized in the P&L. If the asset is being carried under the revaluation model, then whatever the impairment loss is, that would be recognized against the revaluation reserve. In case if the revaluation reserve is exhausted, that is, for example, the impairment loss was, let's say, 80 million and the revaluation reserve that was available was 70 million. So what are you going to do? You're going to say that 70 million is going to be allocated to revaluation reserve and the balance amount is going to be allocated to the P&L, which is going to be 10 million. So in case if you have an asset which is being carried under revaluation model, the impairment loss would be recognized against revaluation reserve. Once the revaluation reserve is exhausted and if you still have an impairment loss to be allocated, you would allocate it to the P&L. Now, the important thing is that when do we have to test an asset for impairment? Now, what exactly do you mean by testing an asset for impairment? Testing an asset for impairment would actually mean that basically test the calculation of the recoverable amount, which is the fair value less cost to sell, which is the value in use. Now, do we actually have to test an asset for impairment at each reporting date? The answer is no. So when do we have to test an asset for impairment? We have to test an asset for impairment whenever there are indications for impairment. What exactly do you mean by having an indication for impairment? So the indications for impairment could be from the external source and from the internal source. I can give you a few examples of the external and the internal source. The external source of indication is that the market value of the asset has gone down. The external source of indication could be that there is adverse technological, legal, etc. movement in the environment that has taken place. So because of that, your assets valuability, your assets recoverability is going to be in danger. Furthermore, there is another thing which is called the market capitalization of the entity is less than the carrying amount of its net assets. What do you mean by market capitalization? Market capitalization means stock exchange value of the company. So the total stock exchange value of the company is going to be termed as market capitalization. So when we talk about the indications of impairment, you have to keep this thing in mind that there could be some external sources of indication, which is market value goes down, which is there is an adverse technological, legal, etc. change. The market capitalization of the asset is less than the carrying amount of its net assets. These could be the different things that are ultimately going to indicate that there is an impairment. So in case if any of the condition exists, you would test the asset for impairment. What do you mean by testing the asset for impairment? Testing the asset for impairment means calculating its recoverable amount. What are the internal source of indication? So maybe there is a damage to an asset. At times within the organization, when the manufacturing process goes on, there could be a damage, there could be an accident internally that goes to show you that the asset is not worth as much as it was. The performance of asset is worse than expected. Now, what do you mean by the performance of the asset being worse than expected? Try to understand that. Assume that you brought a machine and you were being told that this machine is going to produce 100 units in 1 hour's time. Now, when you actually started utilizing the machine, you realize that the output is only 70 units. So we paid the money for 100 units per hour, but we are getting 70 units per hour. That means the machine is not going to be worth what it was. And there could be other indications also. So again, to have a quick recall, when do we test an asset for impairment? Whenever there are indications, and the indications could be from the external source, could be from the internal source. Let's move a bit forward. The next thing is that there are few assets, IAS 36 specifically mentions few assets for which you have to test them for impairment at each reporting date. You have to test them for impairment at each reporting date, irrespective of the fact whether there is an indication or not. What are them? Their goodwill. So goodwill that you acquire, the goodwill of a subsidiary that you acquire, that needs to be tested. Intangible with indefinite life. You do know that there are two types of intangibles. One with a definite life, that is amortized. One that is with an indefinite life. The indefinite life intangible asset is not amortized but is tested for impairment at each reporting date, just to make sure that its carrying amount does not exceed recoverable amount. And the intangible under development. So under development means the asset which is being produced, the intangible which is being developed, that is also going to be tested for impairment at each reporting date, irrespective of the fact whether there is an indication or not. Now let's move a bit forward. There is something which is called indication for reversal of impairment. What is this concept? Let me have a quick recall of this concept. You see, there were circumstances that indicated to us that the impairment has taken place. So again, there could be a reversal of these circumstances. The market value of the asset went down. Again, there could be some change in the environment and the market value can go up. There was adverse technological, political, legal, technical impact on the organization's product. But now what has happened is there is a favorable impact. The government's policy has changed. The legislative environment has become more productive, has become more supportive. So ultimately the value of the asset can go up. So what you need to do is that you need to keep this thing in mind, that if the impairment has taken place, the reversal on that impairment can also take place. Do we have to test for reversal? Yes. Remember, there are two things that you have to do every year. What are those two things? You have to, number one, test for indications of impairment, and the second thing is test for indications of reversal of impairment. So I repeat, these are the two things that you have to do at each reporting date, which is you have to test for the indications of impairment and you have to test for the indications of reversal of impairment. So once you have recognized impairment, then you have to do two things. What? Test for indication that further impairment loss has not taken place, and the second thing is that the impairment loss that was recognized, there might be indications that might be conditions that indicate that the reversal has to be recognized. So this is what you have to do. This is what you have to keep in mind. Now, so what could be those indications? Again, market value goes up. Again, favorable technological environment. Again, the performance of asset is more than what was expected. So this is how things are going to go about. The next thing that we are going to do is that we are going to now discuss that how do we recognize the reversal of impairment. Okay, so the next thing that we need to understand is that how do we recognize the reversal of impairment loss. So for this you need to understand this thing, that whenever the reversal of impairment loss takes place, so you have to recognize this loss reversal in the P&L. That means you have to recognize it in the P&L. Now, for example, if there was an asset which had a carrying amount of, let's say, 100,000 and the life of that asset was, let's say, 10 years. What happened was, at the end of year 1, the carrying amount of the asset is going to be 90,000. Now the recoverable amount of the asset is 75,000. Now the recoverable amount of the asset is 75,000, or let's say the recoverable amount of the asset is 81,000. So there is going to be an impairment loss of 9,000 that is going to be recognized. What happens is, at the end of year 2, at the start of year 1, the start of year 2, the carrying amount of the asset has become 81,000. The depreciation that we are going to recognize, the depreciation is now going to be 81,000 divided by remaining life of 9 years. So this is going to be 9,000. So resultingly 72,000 is going to be the carrying amount. Now what we are being told is, we are being told that the recoverable amount of the asset is 80,000. The recoverable amount of the asset is 84,000. So that means there is a reversal of 12,000. The question mark that arises is, how exactly are we going to recognize it? The question mark that arises is, how exactly are we going to recognize it? So what does IAS 36 tells you? IAS 36 says that whatever the reversal of impairment loss that arises, you have to make sure you recognize it in the profit and loss account. Now, is there a limit to the reversal that can be recognized? Yes, obviously. First thing is, it should not exceed the impairment loss that was previously recognized. If you had recognized 9,000 as an impairment loss previously, you cannot recognize a gain of 12,000. I repeat, if you have recognized an impairment loss of 9,000, you cannot recognize a gain of 12,000. You cannot do that. Now what else is there? There is another condition that you have to keep in mind. And what is that? That is, the reversal should not exceed. The reversal should not lead to an asset being carried above its depreciated historical cost. The reversal should not lead to an asset being carried above its depreciated historical cost. What do you mean by this? So basically what happens is, if there is a gain of 12,000, can I recognize it? No. What is the maximum gain? 9,000. So shall I recognize 9,000? No. First of all, you need to see that what is the carrying amount of the asset right now. The carrying amount of the asset right now is 72,000. What is the recoverable amount of the asset? That is 84,000. There is a depreciated historical cost that you have to calculate. There is a depreciated historical cost that you have to calculate. What is a depreciated historical cost? The depreciated historical cost means carrying amount if there is no impairment. I mean, it's a notional carrying amount on the assumption that there is no impairment. How would you do it? You would simply do it this way. You would say if this asset was normally depreciated and not impaired. I repeat, if this asset was normally depreciated and not impaired, what would have been the carrying amount? So you would say 100,000 is the cost less 100,000 divided by 10 multiplied by 2. So resultingly 80,000 is the depreciated historical cost. What do you mean by this? That in case if this asset was normally depreciated and not impaired, this is what the carrying amount of the asset would have been. So what happens is the depreciated historical cost is 80,000. So basically the maximum gain that could be recognized is 8,000. Maximum reversal that could be recognized is 8,000. So what are you simply going to do? You're going to say that the asset is debited by 8,000 and the P&L is going to be credited by 8,000. So I repeat it again. What did I say? I said that whenever you have to recognize the reversal of impairment loss, the reversal of impairment loss has to be recognized in the P&L. Is there a limit? Yes. The limit is that the reversal should not exceed, should not lead to an asset being carried above its depreciated historical cost. Now, there is one final thing that we need to understand with respect to, I repeat, there is one final thing that we need to understand with respect to this reversal, and that is basically that there are few assets on which the reversal is not allowed to be recognized. And what exactly are they? That is goodwill, that is brand, that is customer list, etc., etc. Now, you would say why? Because as per IAS 38, there are few assets that are not allowed to be recognized. What are those assets? Internally generated goodwill cannot be recognized. Internally generated brand cannot be recognized. Internally generated customer list cannot be recognized. So in case if I had a customer list, I impaired that customer list. Now if I say that there is a reversal of impairment, that means that there is a new list that has been generated. So that is going to be wrong, because then I would be violating IAS 38. So you cannot recognize it. So you remember this thing, that the reversal of impairment loss shall not be recognized on the goodwill, on the brand, on the customer list. These are the assets for which no reversal is going to be recognized. Okay, there is another concept in IAS 36 which is called the cash generating unit. Cash generating unit. The cash generating unit is also termed as CGU. What is this cash generating unit, or what is this CGU? Let me explain to you. At times what happens is an asset's value in use cannot be calculated. At times an asset's value in use cannot be calculated. What is the reason for not being able to calculate the asset's value in use? The reason for not being able to calculate value in use of the asset is because it does not generate cash flows independently from other assets. So in case if you have an asset for which value in use cannot be calculated, then what you are going to do is that you are going to test that asset for impairment on a CGU basis. What are you going to do? You are going to test that asset for impairment on a CGU basis. What do you mean by testing an asset for the CGU basis? Testing an asset for the CGU basis would mean that the CGU, or the cash generating unit, is the smallest identifiable group of assets which are capable of generating cash flows independently from another asset. I repeat, in case if you are not able to establish the value in use of an asset because it does not generate cash flows independently from other asset, then you have to test that asset on the basis of CGU. That is, you have to make this asset part and parcel of the CGU. Now what do you mean by this? This would actually mean that that you need to identify those group of assets which in combination generate cash flow. I've taken an example of a soybean factory. There are many departments in soybean factory. There is a packaging department, there is a distribution department, there is a storage department, there is a marketing department, etc., etc., etc. But there is a portion of the soybean factory that is pertaining to the production of that soybean oil. And there are multiple assets that any soybean factory would have with respect to production of soybean oil. And that is crude storage tank where the crude oil pertaining to soybean is stored. The pipings which travel the soybean from one tank to another tank, from one process to another process. Then neutralizer, which actually neutralizes that oil, removes the acidic content. Bleaching tank, you could see that the cooking oil has got a same color. So that same color is because all of this is bleached out. You cannot have the soybean with the same color across the globe. The soybean color across the globe changes. So if the soybean color across the globe changes, so what actually happens is, this is something that you have to keep in mind, that the bleaching tank is going to be there, which bleaches out this soybean. And lastly, the finished good storage tank. So assume that I was required to calculate the value in use of the neutralizer and I was not able to do it. So what am I going to do? I'm going to consider all those assets which are a smallest group of assets which can generate cash flows independently from other. So I identified that all of them combined can generate cash flow independently from the rest of the factory. So this is going to be considered as a CGU, the cash generating unit. What am I going to do now? What I'm going to do now is that I will test this CGU for impairment in the same way as I do it for the other assets, which is that I will compare the carrying amount with the recoverable amount. If the carrying amount exceeds recoverable amount, there is going to be impairment. If the carrying amount exceeds recoverable amount, there is going to be impairment. Now what are you going to do? Whatever the impairment loss that would arise, the first thing that you have to do is that you have to allocate that impairment loss to the goodwill in that CGU. So there is no goodwill mentioned here, but there could be a subsidiary which you are testing for impairment. There could be some CGU of a subsidiary that you are testing for impairment. So some portion of goodwill is allocated to that also. So if there is a goodwill that you are testing for impairment, I repeat, if there is a goodwill which you are testing for impairment, so what you need to do is that you have to allocate the impairment loss to the goodwill first. Once it's done, the balance loss shall be allocated to the remaining assets on a pro rata basis. What do you mean by this? For example, you've got all these assets. Assume that the impairment loss that is available is 50,000 that needs to be allocated. So how would I be allocating this 50,000? Assume I need to allocate this to bleaching tank. I would say bleaching tank is also 50,000 out of 250,000. So the impairment loss of 10,000 would be allocated. So the impairment loss of 10,000 would be allocated. So you need to allocate it to all the assets on a pro rata basis. Is there a limit? Yes. When you are allocating this impairment loss, you need to make sure that none of the asset goes down below its recoverable amount. So for this, IAS 36 gives you guidance that you should not write down any asset below the higher of. Below the higher of its fair value or value in use or zero. Fair value, value in use or zero, you should not write down below the higher of these three. That is, if the fair value is, let's say, 100 million, the value in use is 110 million or 0. So you have to make sure that the allocation should not lead the asset to be carried below 110. So this is basically a quick revision of IAS 36 impairment of asset, covering when does the impairment loss arises and how the impairment loss is recognized, what are the indications of impairment, what are the indications of reversal of impairment, and at the same time how reversal of impairment is booked, and lastly the concept of cash generating unit and how the impairment loss is allocated to cash generating unit. So hopefully that this quick revision of IAS 36 was fruitful for you. Thank you.